All right, Chris, we're just going to give our audience members a few minutes to jump in here since we're just probably 20 seconds or so ahead of our go time.
Sounds good.
All right. So I was, first of all, welcome all of the Summit community and any of our guests in the professional beauty sector for joining us. And certainly want to say thank you to Chris Whittick and Tracy Stevens at Boyum and Barcher, who have remained our close allies over many years now to ensure that we have the ability to present not only timely but tangible information to the professional beauty industry. I was saying to Chris a little bit earlier that back in 2020, I feel like we were doing these webinars like every second day.
It was every week, it seemed like, for a while.
Yeah. And, navigating through all of the things that we were dealing with. And, Chris, I know I said it many times then, but I just want to say it again to everybody. Thank you, because what you were able to help us get through and the impact it had on not just our clients, but even people that were relying on your advice and our advice during that time. There's not a summit that we do. And this is, 5 years post that, where I don't have somebody standing up and just saying, hey, I want to thank you very much. So from ERC and
Yeah.
taking the time, by the way, that you took to sometimes read things overnight and report it back to us. And I know you've been spending a significant amount of your time actually reading this whole bill.
I do. I actually read these things. It's a page
Yeah.
turner, let me tell
Yeah,
you.
the page turners for sure. So we're going to ask that you guys do use the Q&A feature on here as we go through. We will try to get to as many questions as we can for sure. We are going to go through our presentation and we'll kind of see if there's natural places to stop on the Q&A. But this is recorded, so you'll have access to that. And then you'll also have access to the slides in this presentation, as well as some other handouts that Chris and Tracy have put together that we feel will be beneficial for you to have that info. And then I have two QR codes on here that I just want to say on the front end. So, in general, if you feel like you need some additional assistance with your profit loss, clearly anything on the financial side of your business, there's a QR code here where you can reach out to our financial services department. If you have questions as we're going through and you just want to speak to a coach about that, there's a QR code here that you can connect with a coach. And then, Chris, do you mind going back just one here too? Because I think you have if you need to reach out to Chris and I, you can certainly DM us on Instagram. We're both on Instagram. And then we'll also provide contact information for Chris and Tracy before we jump off today. So lots of ways to get a hold of us if you need some additional info.
All right, should we dive into this?
I guess let's get into it.
Let's do it. So just a little background on me. I'm at an accounting firm here in Minneapolis. We have 125 people, but we have a group that just focuses on the salon industry. Tracy heads that up. I do all the reading. She lets me read the bills for her. So it is the one big, beautiful bill. Normally, I've always got the tiger behind me, but I'm here in the office today, so I had to make some very stupid AI art of tigers in here.
I was going to ask you, hey, Chris, can I just ask you, we've got a couple of people that are wondering if you can actually put this in presentation mode. They're probably trying to watch it on their phone. It's a little bit harder for them to see.
I can. Oh my gosh. Oh, it's enormous on my screen. But yeah.
Okay, thank you for that.
People still see that. Yeah, I'm the tax tiger. That's kind of what I go by. Some of the information in here is what we did with our full firm, and it is not going to apply to salons, and I'm going to go by it very quickly. That is on purpose. If you want to talk about, Section 174, I'm all ears, but there's not a single salon in America that has a problem with it. So I wanted to leave some of those things in there just because I'm not sure what people are necessarily affected by or what other things they have going on. So I figured I just leave it in there, even if I blow it by quickly. That being said, there are things specific to the salon industry that matter a lot. We're going to spend a lot of time talking about those. So that's later on in the targeted tax provisions. I have not forgotten about the tip credit. I have not forgotten about the no tax on tips. We will definitely cover those before the hour is up, and we will attempt to answer all of your questions about it because I'm sure you will have some questions. So we're just going to start with these individual tax provisions. The tax rates themselves have not changed. They've basically just remained the same. So people are not going to notice a change on that end, which I think it generally speaking is good. People aren't going to see their rates go up. So just to sort of start with the most basic stuff that does apply to everybody, your individual tax rate is not changing. The standard deduction was raised up about 8 years ago, and they have this higher standard deduction. That concept remains the same. And so again, you're not going to see like a huge difference on your individual return for that because that's sort of what the rules were. So $31,500 for joint is the standard deduction, and that's just going to keep going up a little bit every year. We will talk about some changes to itemized deductions, so that could change whether or not you're sort of benefiting from or claiming the standard deduction or not. But the standard deduction itself, just a small change. The personal exemptions had been eliminated a number of years ago. They remain eliminated, so no change there. One of the changes that got a lot of publicity and is not super complicated is the senior deduction. So this was sort of dubbed the no tax on Social Security. That's what they called it. In reality, that's not what it is, but it is a deduction for anyone over the age of 65. So it's a $6,000 deduction, and it's based on your age. It has nothing to do with whether or not you are claiming Social Security. It has nothing to do with whether or not your Social Security is taxable, but you just get a deduction, an extra $6,000 deduction if you are over 65. But there is an income phase out there. It starts at 150 for joint, goes up to 250,000 for joint. So that's a sort of one of the big ticket items that they always like to talk about. It certainly will have an impact, but it's about $6,000 per person. So if both were over the age of 65, you could get the 12,000, but it does phase out for the higher income people. Child tax credit, if you have children, small change there. I've got 2 kids, so the way the child tax credit works hasn't really changed, but just the amount has changed from 2,000 up to 2,200. So not a big structural change there, but sort of a little increase to what you're going to get if you're qualifying for that child tax credit. The estate tax exemption changed a little bit. It was made to be permanent, which is nice when you're doing estate tax planning, but that's for, pretty wealthy people. It's a $15 million estate exemption. The mortgage interest limitation really didn't change by very much. There's small changes to the casualty losses. One of the changes was good, one of the changes was bad. I don't know why they really do this kind of thing where there's good news and there's bad news on the same topic, but they expanded it just so that the state governors could declare those disasters, which will help. And that's true whether you personally live in or your salon is located in an area where ends up being a disaster. It often takes the federal government a long time to declare it the right kind of disaster for tax purposes. But now the state governors can do that. So a slight win if you have a disaster. So you wish to not participate in the casualty loss rules, but if you have to, I think there's a slight win there.
I think us Floridians would just prefer that we not have any hurricanes this year like we
Just,
have done.
I mean, no hurricanes in Minnesota. You're welcome to spend the winters
Yes,
here.
but state tax in Minnesota and no
That's
state tax
true.
in Florida.
That's
So.
true. The gambling losses, this kind of got snuck in at the end of the whole bill. In the past, if you have 100,000 of gambling winnings and 100,000 of gambling losses, they would offset, and you'd essentially owe zero tax. Now you can only claim 90% of the gambling losses, which seems a little odd. So you're going to have 100,000 of income, but only 90,000 of deduction, and you are going to end up paying tax, even though you didn't make any money. You're going to incur a tax liability, which is very strange, I
Should
would
we
say.
just add that to the reasons why you should be careful when you're gambling?
You should, yes, you should definitely be careful gambling, because your losses aren't even fully going to offset your winnings some of the time. So actually, there's already a movement from some Nevada-based Congress people to repeal this aspect of the bill. It's been 2 days and they're already trying to repeal it.
Not surprised.
Now, one of the big changes which does apply very broadly is what they call that SALT deduction, the state and local tax. And so this is where you have some very different outcomes depending on where you are. So Minnesota, our taxes are relatively high for income taxes. You know, it goes 5, 8, 10% at the high end. Florida, you get zero. So there's a cap. There has recently been this cap of $10,000 that you can deduct for SALT. And that led a lot of people to claiming the standard deduction instead. Because now you can't claim all of your state taxes. You can only claim 10,000. Meanwhile, they raised the standard deduction. So it just pushed a lot of our clients into the standard deduction. Now they have changed it, and there's been a lot of talk about this because this was the key provision that was holding up the bill, right? Because this bill was pushed through by the Republicans, but there are some Republicans who are in Minnesota where the taxes are high, and so they want it to be raised. Vice versa, you know, there are Democrats in Democrats in red states, you got Republicans in blue states. So it's just a very strange dynamic, and it held up the whole process. So now the cap is 40,000, which sounds great, and it is, but there's a phase out. So just because it's 40,000 doesn't mean that everybody can claim 40,000. If you have it, there's a phase out, and the phase out happens between 500,000 and 600,000 of adjusted gross income. So if you're at 500,000, you can claim the $40,000 SALT deduction. And if you're at 600,000, you can only claim 10. So you're losing this entire benefit in between this range of 500 to 600,000 of income. So if your income for the year is 200,000, you can ignore the next 4 minutes. But the example here, which is small, but we'll talk about it, it's easy to understand, I think. If you have wages, just the most simple scenario, you got wages of 500,000, some basic itemized deductions, you can claim the $40,000 SALT deduction. Great. If your wages are 600,000 instead, now you can only claim 10,000. So what happened? Like, I added $100,000 of income, but my taxable income went up by 130,000 because it went up by the 100 of income plus the 30 of deductions that I lost out on. And so when you look at the effective tax rate of that, it is very high. And this is why I'm making the point. So if your income is 500,000, the marginal tax bracket is 32%. Your income is 600,000, the marginal tax bracket is 35%. But in between this 500 to 600 range, your effective tax rate on that ends up being 43.5%, which is higher than any of the rates that you could possibly be paying, because we've talked about the top bracket is only 37%. And yet, if you are in between this range of 500 to 600 and you have SALT, your effective tax rate ends up being 43.5% on every extra dollar over 500,000. So you especially need to be careful in that range in a way that you never had to be careful before. It is a very important, but you need that SALT deduction, right? So if you're in Florida and you don't have the SALT deduction anyways, you're not really losing any deduction when you're phasing out of it because you weren't claiming it in the first place. But if you're in Minnesota or New York or California or wherever, like, you're losing that deduction, and it's very important. So a unique new planning thing for people with income between 5 and 600,000. So as we keep going, there's a bunch of other individual tax provisions here that could apply to you, and maybe they don't. So vehicle loan interest, maybe you've heard about this. Now you can deduct up to $10,000 of vehicle loan interest. There are some rules around that. Like, it has to be a new car purchased, has to be assembled in the United States, has to be 2025 or later. And there's also an income phase out, which is common on a lot of these things. You get a deduction, but not if you're high income. And on every single one of these, they define high income differently, which is annoying as heck for me, but you just need to be careful. So for this one, it starts phasing out at 200,000. This is not an itemized deduction. This is a brand new line on the tax return. This line did not exist, and now it does. There's Trump accounts. Maybe you've heard about those. Eligible children are ones born in 2025. So like, I have a 11-month-old at home. He was born last year. He doesn't get this. Only 2025 to 2028 births. So basically the government throws in $1,000. There are some ability to contribute additional dollars into them. I think it remains to be seen how useful these accounts end up being. The $1,000, definitely useful, right? If the government gives you a free $1,000, that is helpful. Will you actually want to use this account and contribute more money to it? I'm not so sure. It works kind of like an IRA. It works kind of like a 529 plan. It works kind of like an ABLE account. You might be better off using those other types of accounts to accomplish similar results. So I think it remains to be seen to see how it shakes out and how useful these are. But certainly that initial contribution from the government is terrific. A lot of other things with itemized deductions, like the miscellaneous itemized deductions, were eliminated before. They remain eliminated, so not a big change there. Dependent care credit changed slightly. Just the percentages are a little bit higher. There's a new tax credit for contributing to scholarship granting organizations. It seems kind of complicated to me, but it doesn't start until 2027. So I think there's some guidance that needs to shake out on that. So stay tuned, but that's a problem for another year. 529 plans have been improved because you can use them for other types of qualifying expenses, which is great, including things like the CPA exam. I realize you guys are not CPAs, but encourage your children to become CPAs. They can use their 529 money for getting credentialed now. And then the last two things on here are going to matter if you ever give money to charity. And this, we're back to like one good thing and one bad thing So we're both encouraging people to give money to charity while also discouraging them from giving money to charity at the exact same time. I don't get the idea behind this, but I can explain what it is. So if you do not itemize, they're going to let you deduct 1,000 if you're single or 2,000 for joint if you have cash charitable contributions. This is a new line on the tax return again. So if you were claiming the standard deduction and you're like, well, I gave $1,000 to charity, but it's not enough to itemize, you're just not getting any tax benefit from that under the old rules. Now, the new rule, you can claim the standard deduction and you can claim this deduction, so you can still get some benefit from donating cash to charitable organizations, which is great. On the flip side, if you do itemize, they've created a new floor, a new hurdle that you need to clear before you can actually benefit from your charitable contributions. So the floor is a 0.5% of AGI. It works similar to the way medical expenses work with a 7.5% floor. So if you have $200,000 of income, that means that the first $1,000 of charitable contributions do not actually produce any itemized deduction. The first 1,000 is the hurdle that you got to clear. It's the floor, it's the base that you got to clear. So you're just getting no benefit from those, but you are getting benefit if it's higher than that. That same person that gives $1,000, if they itemize, they get no benefit. If they claim the standard deduction, the point above it, like they do get $1,000 deduction. So I think that's going to change sort of, are people itemizing or are they not? The math on that, I think, is a little weird. So I'm not sure what they're really aiming for, but good news and bad news at the same time for charitable contributions. Some business tax provisions now. The first two here definitely apply to salons. Bonus depreciation is back. 100% bonus depreciation is terrific. So this is for any new purchases or expansions of salons. So if you buy a bunch of new stations or you're building out a new space and you got new stations, bonus depreciation is how you get a big tax write-off when you first purchase and place those things in service. That is super helpful. The old law had it being only a 40% bonus depreciation this year. So now it's up to 100% and it's going to be permanent, which is great.
Okay.
Section 179 works a very similar way. You can elect to expense some of those improvements. So that was increased. So this is very helpful when you have a large capital expenditure. You know, if you have $5,000 of capital expenses for the whole year, you're not going to notice this is a difference. But it's when you've got a big build out and you're like, yeah, we spent $200,000. You know, we added a room over here and we took over some new space and stuff, or you started a new salon or a new location. These rules are going to be super helpful. And it'll get you more tax deduction in the year you open that new space. So super helpful for those people. I'm not even going to talk about these other two. They're very rare that they would ever apply for a salon. I can't imagine they ever would. Qualified business income deduction, it stayed at 20%. Salons get it. It's at 20%. That's great. So this has been true for a while, and this part remained the same. And so the way it works is that, if the salon makes $100,000, there's a QBI deduction, which can be 20% of that 100,000. So it would be $20,000 deduction you get just because you have this business income. The point of this slide is aimed really at other types of businesses, which are specified service trades or businesses. A salon is not that. So a salon does not have the limitations we're talking about on this slide, so you don't have to worry about it. these two things are never going to apply to salons. They are really aimed at people who do R&D. Salons don't do things that qualify as R&D. And then people who build manufacturing plants, salons are not manufacturing plants. So these two don't apply, but they are very big, especially if you're in the manufacturing sector. Opportunity zones got extended. Again, I think it's very unlikely a salon would be in an opportunity zone. There's a definitional change for some residential contractors. QSBS stock is really getting at people who own C Corp stock. That's usually aimed at like tech startups. But the last two things on here do matter for salons, and I think it's definitely welcome news. So the thresholds for reporting 1099s have gone up. In the past, they had sort of year over year extended some higher thresholds. Now it's more permanent. So the 1099K threshold is up to $20,000 or 200 transactions. The salon itself is not issuing a 1099K. But this is helpful for your employees who might be getting tipped through an app like Venmo, right? So when the threshold was very low, there was a concern that they would get a 1099 from Venmo, but they also reported those tips to you and you put them in their W-2. So now they got both in their W-2 and a 1099, and that's a hassle for them to get reconciled, and so they're not paying double tax. With the threshold being higher, it certainly helps alleviate some of that, which is good. I think less 1099Ks out there in the world is a win for businesses. Those things are very hard to reconcile. And frankly, they're not very useful. 1099 NEC reporting, or the 1099 miscellaneous reporting, that changed from 600 to 2000. So this is when, like, if you have an accountant and you pay the accountant $1,000, let's say, that seems like a cheap accountant. But if you did, you were sending them a 1099, or you were supposed to be sending them a 1099, and now the threshold is 2,000, so you can skip it if it's under 2,000. So it's just going to result in a few less 1099s that go out to your vendors, which is, again, I think relatively helpful.
Hey, Chris, just because there's a couple questions coming in,
Yeah.
just to clarify when you use the Venmo example. So what Chris is saying is that if they were receiving a 1099 from other entities, it didn't remove your responsibility for reporting that in their income. It's just that this is making this a little bit less complicated, is what I heard you say, Chris.
Yeah, there's going to be less duplicating.
Yeah.
The employee responsibility to report their tips, unchanged.
Right.
The business's responsibility to report tips, unchanged.
Right. So no matter how they're receiving tips, they're supposed to report it to their employer, and the employer is supposed to put that through their payroll, whether it's just an in and an out to pay the tax. None of that has changed, correct?
Correct.
Thank you.
All right.
Oh, sorry. One other quick one while we're in the 1099 NEC. The question is the threshold for the year or the month?
The year.
Thank you.
All of these are yearly. Yeah. So from the salon standpoint, like, there are going to be some vendors that fell between 600 and 2,000, and now you don't have to 1099 them. A little bit less work, which is good.
Yeah.
All right. Energy incentives went bye-bye. All of these just got killed off. Different timelines. Does it matter to the salon in particular? No, but it applies if you were ever going to put a solar panel on your roof. you're not going to get a credit for it anymore. If you were going to replace the doors and windows in your house, there was a credit for that. It's gone in 2026. So if you were going to buy a Tesla and get a tax credit, not anymore. So you got to be clear on when each one of these expires. Generally speaking, they're okay for 25. So you got 5.5 more months to do all the energy things you want to do. And for the most part, they're all just gone entirely starting in 2026. There's a couple of foreign things on here I am definitely not going to mention because you guys do not care. There are some changes to the employee retention credit, and I want to mention these and also mention some other FAQs that the IRS came out with, even though it's not in the bill. So they've increased the penalties for people who do it incorrectly. I'm not super worried about that for salons. They've made it ineligible for claims in the third and fourth quarter of 2021. They were filed after January 31st, 2024. Again, there should be probably very few salons that qualified then, but they're cutting off the claims early. But the IRS did have some FAQs, which I do think are helpful and noteworthy for salons. So one of the issues that people always had is you claimed ERC in 2020, 2021. You're supposed to sort of pick it up as income in that year. But some people didn't want to because they couldn't afford to pay the tax on it because they didn't actually have the money yet. And I work with lots of clients that were just getting their ERC money now in 2025. And so now they're saying, all right, now I'm ready to go back and amend and pay the tax and get right with it. Well, the statute of limitations is closed. So the second FAQ here is the IRS basically giving you an out and allowing you to pick it up as income in the current year when it's received. So that's a whole nuanced conversation, but I think it's noteworthy that as of March 2025, you kind of now have the option to pick up the ERC income in the year you receive it. And I know we work with salons that have just gotten their money either in like 2024 or here in 2025. So having another option I see as a good, options are useful, I think. Now let's get to the good stuff. All right. So no tax on tips. The specifics matter a lot here. There is a $25,000 deduction allowed if your income is low enough. So what does low enough mean? This time it means $150,000 for single or $300,000 for joint. And again, there is a phase out of this. The phase out on this is very, I'll say, wide or long. So if you're single and you make $151,000, you are over the limit. That doesn't mean you lose the entire deduction. It means you lose a small piece of the deduction. And so it's all the way up from like 150 all the way to 400 for a single person. That is the range in which you are losing the deduction. So it has to be a qualified tip. It's important to understand what that means. The IRS is going to determine what industries qualify. Accounting, I don't think is going to make the cut. So accountants who get tips are not going to be able to exclude this. But salons.
Is that a thing? Is that a thing that I'm not aware of?
I mean, I'm
I
trying
feel
to
like I owe
make
you an apology of some sort.
I'm trying to make it a thing. Tip your accountant. So accountants aren't going to be able to deduct this. But salons are definitely going to be on the list. IRS has not announced the list yet. I will bet you my life savings that salons are on the list. So it's a brand new deduction on a line of the tax return that never existed before again. This is temporary. So 25, 26, 27, 28, and then it's gone. It appears to me that the owner of the salon is eligible for this. I'm a little worried that the IRS is going to come out with an interpretation that's different. There were different versions of this written in the legislation. Some specifically excluded the salon owner, but the final bill does not exclude the salon owner. It only excludes high income people. And so maybe the salon owner is high income, but they are not necessarily excluded just because they are the owner of the salon. So I think that's great. So what is a qualified tip? It is taxable to the individual. It's got to show up on their W-2, in box 7. That's where tips go. It must be voluntary. Service charges don't count. That's especially big for like the restaurants around here. A lot of them go to the service charge model. But it can be cash, it can be credit cards, it can be tip sharing arrangements, but any type of tip that shows up in box 7 of their W-2 is eligible to achieve this deduction.
Chris, there's some questions just about the 150,000 and the 300,000, asking if that includes the tips. I hear you saying it's your
Yes.
gross income, so the answer would be yes, correct?
Yes, it's actually your modified adjusted gross
Modified.
income. And the modifications are normally things like some other deductions that you can get, and like if you have Social Security that's not taxable, that usually gets added back. But generally speaking, yes, it is your gross income, which always includes your tips.
Yep. So again, there's more questions coming in. If you're automatically charging, let's say, a tip because it's a party of people, so they're coming in, it's an automatic charge for a tip, then that's not voluntary.
Correct.
Yeah. So just, everyone should be aware of, in my opinion, nomenclature on how those things are stated.
Yeah, very important. When I go to a restaurant with my family and I choose to leave a tip of 20% or 19% or 22% or whatever, I'm choosing that. When I go with my whole extended family and they just put an 18% charge on there, that is not a tip
Right.
for this purpose. And so, yeah, if you've got a big party and you've got an automatic service charge applied, that is not a qualified tip.
Right. And I think it's also important to say right now that the way you're reporting tips remains the same, and the way
Yes.
that you have to pay the taxes on them remain the same, because there's a
Yes.
lot of questions coming in. Like, I think people are making an assumption that they no longer have any tax liability associated with these tips, and that's not accurate.
Correct. We'll get to that in more detail, but this is for the individual taxpayer. Absolutely nothing on this slide is going to be applied to the salon owner, the S Corp itself. There's no change to reporting your tips. There's no change to how you gather the information about your tips. You are not saving any money. It is the employee who might get a deduction on their tax return. I think it's certainly important for the salon owner to understand how this works, because the salon owner themselves, if they are behind the chair and they get tips, they are also an employee that can benefit from this.
Right.
So some owners don't cut hair. They are not a service provider. They pay themselves a salary of $100,000 a year. They don't have any tips on their W-2, so there's no way they can benefit from this personally. And other owners do cut hair, and they do have tips, and they do have tips on their W-2. So even though they are the owner of the salon and the salon gets no benefit from this, it's the individual person with the tips that gets this tax deduction.
Yeah.
All
So
right.
I think the message here is that if you've been doing this correctly, or if you haven't, because there's a secondary question to that, but if you've been doing this correctly, really nothing changes right now. It's really what's going to happen at the end of the year.
It's just good news
Right.
for employees that have tips.
And by the way, no tax on tips does not mean that you're not paying FICA on your tips. I mean, that's something that continues, correct?
Yes, the employee is still paying
Right.
FICA.
And
Yes,
we'll talk about this. I promise everybody,
we'll
we're
get
going
to
to
it.
get to the tax
Yeah,
tip credit in just a second.
we will.
So let me just take a look here for a second. There's a couple questions about if you're a solopreneur or independent and you don't pay yourself with a W-2, how does the tax, how does this work in that particular scenario?
Probably not well. I think you should strongly reconsider whether or not you want to be a Schedule C solopreneur. Um, I think we would need some IRS guidance on that.
But there's
Well,
nothing preventing a solopreneur from becoming an S corp or becoming an
absolutely.
like, and then
Yeah, yeah. An
becoming an S.
LLC, a single member LLC that files as a Schedule C for the last 10 years can absolutely make an S election 1/1/2025, start paying the owner a W-2 with tips,
Right.
and get that done in 2025. That's possible.
So again, some of these are getting nuanced. So, you can reach out to Chris and
Yeah.
Tracy specifically. But to reiterate, when we say FICA, because there's a lot of questions of is Social Security taxes still paid? The answer is yes. I mean, basically,
Mm-hmm.
nothing's going to change in the way you pay tax on the front end, I think is the right way to say it.
Correct. Is the tax deduction that is achieved on your 1040 in April when you file your tax return.
Right.
None of the cash flow the whole rest of the year has changed at all.
Yeah. I think some people are getting a little confused. There's no short end for the business. We're going to get to the tax
We'll
tip
get to the tip
credit
credit.
portion.
That'll help. Yeah.
Right.
So let's keep going and then we'll try and get to those. So I do want to talk about no tax on overtime as well. The way no tax on overtime works is similar. It's kind of this $12,500 deduction, and it's based on just the amount of the overtime pay. So when you have people working at the front desk and they're paid $20 an hour, and the schedule gets crazy and they work overtime, and your state law requires you to pay them time and a half. So now they make $30 for some of the hours or holiday pay or whatever. Like it's that additional $10 an hour that counts as overtime pay. And that's what then they can get a deduction on their tax return. So it's really based on what the labor rules are for how you sort of calculate the overtime. This is going to be something that needs to get captured on the W-2s and is not currently. Like currently, you can look at your W-2, nowhere on there does it say how much was like the hourly wage versus a bonus versus overtime pay. That doesn't exist. So they're going to have to create some kind of new notation on the W-2 to capture this. But the payroll provider should be able to handle this. So there's really, if your payroll provider knows what they're doing, you will not notice a change at all to the business. I just wanted to point out that your employees themselves, they might be eager to take on that overtime because they will get this deduction. So, um, with that, let's talk about the tip credit. Uh,
Okay.
all right. So the tip credit has existed for a long time. There's another partner here who does restaurants and breweries. Every single restaurant and brewery he works with has been claiming the tip credit every year of their existence. The salons have never gotten it. No other industry other than food. Now it has expanded to include the beauty industry, which, and I took this verbatim from the law. They call it barbering and hair care, nail care, aesthetics, body and spa treatments. That is the entire definition. So if you think you fit in that category, and I think you probably do, now you can claim the tip credit. Starting in 2025. Can you go backwards to the past? No. You can start claiming it this year and claim it in the future. They've just been added to the definition. The credit itself didn't change, but the credit literally said only the food service industry. And now it says the food service industry plus the beauty industry starting in 2025. So that's how it's written. The tip credit does not expire, it's here forever. And now the salons are on the good list, knock on wood, forever. Both parties thought this was good policy. So it's not like you're worried 4 years from now the Democrats are going to get in and take it out. Like, that's not going to happen. So we should be good forever. So how does this work?
So that, just to reiterate, because that question's coming in from multiple people, if there is an end date on the tax tip credit.
Not on the tip credit. Okay. Permanent. They've just expanded the definition to include a second industry. Right. But the tip credit's been around for 50 years and it's never had an expiration date.
Right. Yeah, and this is probably a good time just to remind everybody who is listening. The one association was the Professional Beauty Association that has worked tirelessly on this, worked, really, really hard to get this to go through. And a lot of us were, trying to help as well. But if you're not currently a member of the Professional Beauty Association, this would be the time to go join, because that is our only lobbying group. And this is something that they took on and will continue to be taking on.
So how does this thing work? It sounds good. Everyone thinks it's good. You got to actually understand.
Let's get into the semantics. So
let's get some math going. So if a stylist gets $100 tip, the salon pays the IRS $7.65 of FICA, and then adds that tip to their W-2. So the salon has incurred this $7 of cost, even though it was the client that gave them the money. You didn't give them the money. Why are you paying payroll taxes on it? But that's how it works. So the tip credit is exactly equal to the $7.65 that you paid. I got a few examples here, and these are real salons that I work with. $1 million of sales. They had $50,000 of tips reported on their W-2s. You multiply and round just slightly. That's $3,500 tip credit. The $3,500 is roughly the 7.65% of the $50,000 of tips, right? Another salon, 1.1 million of sales. They have proven to be much better at capturing the tips. So they have $175,000 of tips. That's $13,500 of tip credit. A salon with 2.5 million of sales and 300,000 of tips, that is a $24,000 tip credit. So I looked back in my sort of database, and we've got quite a range of how successful salons are at capturing the tips. There's a lot of different reasons for that, and it is not the salon's fault, so to speak, but we've seen some that are capturing roughly 15% of sales. Some are more like 10%, some are 5 or even lower. And So there is a large difference between how much the tip credit is going to be for you, and it's based on how much of the tips you're capturing and paying the tax on. So it's not based just on your sales or how much tips are occurring. It's based on the tax that you're paying in, which is based on sort of how accurate you're able to capture the tips on the front end. So how much are you actually paying out? So I've noticed a pretty big spread there, and we'll see if that changes over time. We'll get into that. So a little more of the details. You claim the tip credit on Form 8846. I know you're not going to remember that form. It's the tip credit form. That's how it works. The tip credit basically flows through your business and into your 1040. It's on the 1040 where you actually save the taxes, assuming you have a flow-through entity like a partnership or an S Corp. The credit itself is a general business credit, which is recognized at the individual level. The credit is not refundable. This is very important. If you do not have a tax liability, you do not get any benefit from the tip credit. So the tip credit is great. It is the best thing to happen in the salon industry in quite a while, but there are limitations, and you have to understand how they work. It is not just this big windfall. We'll get to some specific examples. So the credit itself is not refundable. It can take your tax down to zero, but it does not go below zero. The leftover, you go back, you carry it back a year, and then forward 20 until you have a different year with a tax liability. So you don't lose it, but you have to use it in a different year. That's how this works. So there's a couple different ways to then carry it back and forward, and this gets to be a little annoying, but we'll go through a couple examples and kind of see how this works. So the first example here, salon with $1 million of sales, $100,000 of tips. So $100,000 of tips, you got a 7.65% credit. So that is a $7,650 tip credit. It's one owner, it's an S Corp, the owner works behind the chair, and they manage the business, right? So the salon itself makes $50,000 of positive net income. The owner pays themselves a W-2 of $75,000. 50 of that is salary or commission if you want, plus they got $25,000 of tips. So under the old law, they have $125,000 of total income. They have 50 from the business, 100 of plus 75 of wages, and then they have nothing else going on in their life. They have no other income. They're not married or anything, right? So under the old law, they got $125,000 of income. They're going to get that QBI deduction. They're going to get a standard deduction. They're going to end up with $100,000 of taxable income. Roughly speaking, that's $17,000 of tax if you're single. Under the new law, they got the $125,000 of income. They're still getting their QBI. They're still getting the standard deduction. But now they get to deduct their $25,000 of tip income. The individual's income is below the threshold, so they get the full tip exclusion, and they have $25,000 of tips, so they get a full $25,000 tax deduction, which is super. So that reduces their tax liability. Now, instead of $17,000, it's about $11,000. But now they also get the tip credit, which is $76.50. So their net tax liability is the $3,764, right? So the old law, they paid 17,000. The new law, they pay about 4,000. This scenario, this person saved $13,000 of income tax in 2025 from their ability to deduct the tip from their wages and to claim the tip credit, which is now happening and flowing through to them. So that is a lot of savings. That you're going to feel that difference for sure. I don't know too many people that wouldn't like an extra $13,000. So there's a bunch of limitations here, but you know, this is a scenario I see playing out with some regularity. You got an owner who's behind the chair, they have tip income, they can get the tip deduction. The salon itself is pushing through this tip credit. The owner is going to benefit from that tip credit and sort of be made whole for the fact that the business paid $7,650 of payroll taxes all during the year. And then the owner is going to be able to get it back when they file their 1040 in April, basically. But that's not the only kind of outcome we can have here. So same situation, but now the salon itself has a loss of $15,000. Instead of making money, the salon lost a little money. You know, they were breaking even, and then maybe they bought some new equipment to rehab a space, and okay, so we have a tax loss of $15,000. So we run the same math here. Their income is lower because of that salon income being lower. So their tax liability is less. So under the new law, yeah, they get their tip deduction, which is great. But now their tax liability is only $2,000. But we got this, you know, $7,000 tip credit, but my tax liability is only $2,000. So you don't get the benefit of the tip credit. You get your tax down to zero, so you use up 2,000 of it. But then the other 5,000, you have to carry it back 1 year and then carry it forward 20 years. So you will, assuming you have taxable income and you're paying tax, you will at some point get the benefit from that tip credit, but you are not getting the full benefit of it today because your tax can only go to zero. So I think that's a key limitation to keep in mind. And that's a key example of when you're like, oh, great, I got this $7,000 tip credit. I'm going to get my $7,000 back. You will get it back sometime. But in this scenario, you're going to get 2 back when you file your 1040, and you'll get the other 5 back in some other year. It might be next year. It might be 3 years from now. You'll get it back sometime.
There's a lot of questions because we're saying carrying it back a year, if that goes back to prior years prior to 2025.
Yes. I think it stands to be clarified from the IRS, but I believe you would be required to carry it back to 2024, even though a salon was not eligible for the tip credit in 2024. The tip credit itself existed. So I think there's a slight pause to that answer. I do expect we should get IRS guidance on that, but that's just for this 1 year where you might have a different answer.
Yeah.
But in 2030, you get a tip credit, and you don't use it all. You carry it back to 2029, and then it goes forward, and it'll eventually expire in 2050 if you haven't used it.
So again, to all the questions coming in, no, you're still going to report everything like you have. There's one saying that if the employee isn't reporting to the employer all of their tip income, so whatever is being reported in is being notated on the W-2, but then that same employee puts a higher amount on their personal when they go to do their income tax with their tax preparer? Is the employer liable for the difference that's not reported, is the question.
The employer has a responsibility to report all of the tips you know about and to ask them about tips that you don't know about. And if you ask them and they lie to you, you're fine. It is their problem because they are the ones that lied to you. So I think the best practice is that every pay period, you send something to the employees and ask them to tell you their cash or app tips that you don't know about. And then you document their response or their lack of response, probably. And you save that in your file because that is the proof that you did your job.
Right.
Any bad things that come of that are not going to be for you. They're going to be for the employee. It was the employee that lied to you by telling you they got 0 cash tips for the week. When
So documentation is always key, just like in anything
yes.
else, is what I hear Chris saying. And for all the questions about carrying it back to 2024, because that's not completely clear at this point, I'm just, I don't think it's prudent to.
And it is only if you don't have a tax liability in 2025.
Right.
Like you haven't filed your 25 tax returns yet. You don't know if you
That's
even
right.
have a tax liability. I think the point is just the tip credit can get your tax to 0. Once it gets it to 0, the rest is going to be used in some other year. Might be last year, might be a future year, but you're not going to get that benefit right away in April. It's going to take some time, and it'll depend on everyone's personal tax situation. So if you had 2 owners of this same business and they were 50-50, 2 sisters 50-50 own this business, their individual tax liabilities are not the same.
Right.
One of them might use the tip credit fully. One of them might use part of it and have to carry back part of it. So the individuals determine the utilization of this credit. It
And
just
so
flows through the business, gets used by the people, the individual.
a lot of questions coming in around that, Chris, like when you have shareholders. So
Yep, everything gets shared pro rata. So if you have 8 shareholders that all own 12.5%, everybody gets 12.5% of the income if you have an S corp, and then they get 12.5% of the distributions, and they get 12.5% of the tip credit. So it gets shared sort of pro rata. There's no differences there.
right.
It's going to follow the income. If they get half of the income, they're going to get half of the tip credit.
Right. And then additionally, on that note, many people asking, like, what if I hadn't been reporting tips and now I'm reporting tips? There's concern about, does that trigger an audit from prior years?
There's no time like the present to get on the right side of the tax law.
Yeah.
Is doing the right thing today going to raise a red flag for the past?
Right.
Probably not.
I think it goes
But
back to everybody's individual life strategy. You have to decide, are you someone
yeah,
who cheats the government or somebody who, complies? And to Chris's point, if you want to get in compliance, then you got to get in compliance at some point.
yeah, I think I will get at the end. I have a few slides about just so what now? I think now is a great time to reevaluate and be maybe more intentional about collecting that tip information. I think the employees themselves might do more self-reporting. Even if you have a perfect process, the employees had an incentive to lie to you before. And now they kind of don't have so much incentive to lie to you. So perhaps they will be a little more honest. And when they are more honest with you about their cash tips, you are going to end up paying more FICA tax, but at least now you get the tip credit So you'll be made whole at some point.
Right.
You know, it's not an immediate cash savings, but it's something you can bank on in your tax planning. So it will come to pass, but I think you just want to sit down and reevaluate a bunch of things like, are we doing this correctly? We know the IRS has got a brand new line on a tax return for deducting tip income. We know they expanded the tip credit to salons. Are they going to start auditing more things about tips? I have no idea. But the tax law has changed. It's just a good time to reevaluate. And, you know, there's a huge sort of gain here for the salon owner that at least you're not being penalized anymore. Before you were being penalized, you were
Yeah.
paying the tax on all these tips, and at least now you're going to get to be made whole. So it's not as rough for the actual salon owner, which is long overdue. Um, so let's just recap a few things, and then I have a few more practical advices, and we can answer some more questions. Just a recap on the individuals, like there are new deductions here for seniors, for vehicle loan interest, for charitable contributions, for tip income, for overtime income. There are changes to itemized deductions. The SALT cap changed, the floor on charitable contributions, the 90% of losses for gambling, casualty rules changed a little, energy credits changed. For businesses, you got bonus depreciation, you got Section 179. That's super helpful for salons. The 1099 reporting has been loosened, so there'll be a few less 1099s, which is super useful. So some other planning thoughts to keep in mind. The effective dates on some of these provisions are just all over the board. Some of these things are effective 1/1/25, 1/1/26, 1/1/27. So just be careful. Not all of these things apply immediately. Not all of these things apply effective 1/1/25. I will also say that permanent, a lot of these things are permanent, which is great. Some things are not permanent, they're set to expire. Like the tip income deduction is here for 4 years and then it goes away. Even the permanent, it just means as long as or until Congress changes their mind. The energy credits were passed 2 years ago and they were permanent. And now they're all eliminated 2 years later. So they were permanent, they got eliminated. I think it's important to point that out. Congress is already
Wait, Chris,
talking about, yep,
are you saying the government reserves the right to change their mind?
they change their mind frequently. In fact, they're already trying to on this bill that they passed a week ago. State conformity is an issue for some states. Minnesota has a big problem with conformity. So when there's a tip deduction, like that's great. Does that tip deduction also apply to the state you live in? And the answer is yes in some states, no in other states, and maybe to be determined in some other states. So what we've been talking about is just the federal. This stuff does not necessarily apply to your state, and each state is going to deal with it a little bit differently. If you're between 500 and 600,000, you really got to be careful with your planning. I would certainly encourage people to do a tax plan this summer. Maybe you're used to just doing a tax plan in December, and most years that's fine. Now we've got the tip credit. Now we've got this tip deduction. We've got the other individual changes like the SALT. If you were ever going to do 2 tax plans in a year, 2025 should be the year. So I would take a look at it and then look at it again. As I've kind of mentioned, they're already talking about a second reconciliation bill or repealing some things that they just passed. So there will not be a massive, massive bill like this with huge, huge changes, but Congress can change their mind about some small things, like the gambling losses in particular, seems likely to get modified. So if I'm a salon owner, what am I specifically going to do? I'm going to reconsider how the owners get paid. for sure. If they are cutting hair and getting tips, you got to be sure the tips are getting on their W-2s. I would reconsider, just reevaluate your procedures for capturing the tips from employees. And I think it couldn't hurt to inform them about the tip deduction. They all hear the news, maybe they've already heard it, but I think being a resource for them is a good look for you as the employer. Maybe just reconsider those hourly employees and make sure you're sort of complying with the local rules about how overtime pay works, because those employees might now be keenly interested in it. Work with your payroll provider just to be doubly sure that the tips are getting captured and reported in box 7, and that the overtime pay is being captured if you have people getting overtime. I'm not sure which box, they haven't said which box the overtime is going to go in. Logically, it'll either be box 12 or 14. Like if you use ADP or Paychex for your payroll, they're going to figure this out. I'm not very worried about it. If you use a smaller payroll provider or you are doing it yourself through QuickBooks or something, you're going to have to pay some special attention to this. And then I would just say, for some people, the tip credit is going to be a big number, and it is going to change the way you think about taxes, or it could. Because if the tip credit was going to offset 100% of your federal income tax, what would you do differently?
Right.
This is an opportunity you've never had before. If you're like, yeah, usually I pay 10 grand, 15 grand of income tax, and now I got a $15,000 tip credit that's going to cover it. You would make different choices in other areas of your life that have nothing to do with your salon, right? A retirement plan, you're like, great, I get a tax deduction for contributing. Well, if your tax rate is 0, why do you want a tax deduction for contributing? Maybe you want to contribute to a Roth instead of a regular. So it can change some of these other things in your life. You could do Roth conversions. If the tax rate was going to be 0, that would be the most amazing planning you could ever do. That would be tremendous. How do you look at capital gains? What do you invest in? If your taxes were going to be 0 at the end of the year, would you withhold anything on your wages if you were the owner? You wouldn't need to. I mean, you have to do the payroll taxes, but the federal income taxes, like, you can reconsider all of these things. You maybe don't have to wait until April to get the cash benefit. You could cut off your withholding tomorrow because you know you have this credit coming later. So I think it just changes the mindset of how you look at, charitable contributions and all these tax deductible choices you make every day. So this is my sales pitch. I've saved it for the very end, and then we'll answer all of your questions for the next 2 hours if it takes 2 hours. If you're the one that's got to tell your CPA that your salon qualifies for a tip credit, I think you need a new CPA because they didn't read the bill. And if they didn't read the bill about the salons getting the tip credit, what else did they not read in the bill? Because there's a bunch of stuff in there. The team, Tracy heads it up. Salon.cpa is how you can find us. We work with salons. I like to think we're very good at it. If you want to be in control and get a handle on this stuff, because your current CPA does not. This will be one of the resources we have that we'll just have for you posted. There's 10 red flags. So if I find a new client and I see any of these things occurring, it's kind of a red flag that, like, maybe you don't have a good handle on the tax situation. So we'll include that with a tip credit 1-page kind of summary. There's Tracy's information. You can always find me too. So what are the other questions?
Yeah, so I think some of them that are sitting in the unanswered were actually answered as you were talking, Chris. So we tried to get most of those out there. again, there's a lot of questions about carrybacks and self-employment tax and FICA. And basically what we were saying is you want to keep doing things the way that you were doing it. I think Chris did a good job of explaining what that looks like on the back end. Also explain the shareholders. So it is going to be based on, it's going to be aggregately applied to your shareholders, and you can go from there. Another question just coming in, like, I guess if I'm a sole proprietor, I need to change. Chris answered that as well. So if you want to go on the replay and listen to that. And then there was one, if is the 500,000 individual income or combined household income was the last one that came in on the Q&A side.
Both. I don't know if that's a fair answer, but both.
Yeah, I would say for that
File
one,
jointly, both.
yeah. Again, if you want to specifically get tax advice based on your household, I do recommend you reach out to Tracy and just find out what your options are with OYM. I think, Chris, what you said loud and clear to everybody is that if you're working with a firm that's not actually proactively talking to you about these changes and how it's going to impact you and your household, then you just want to think about, are you working with a company that is what I would call strategic versus just doing your tax return? To me, that's two very different entities. A lot of things coming in on the chat about credit card fees and passing them to clients. That wasn't the purpose of this particular conversation. Only thing I would say to that is states have different laws around that. You can't do that in every state. So please make sure you know. In some states you can, but it's only up to a certain percentage. So just again,
And if you, that is not going to count as the tip.
correct.
So like if you're allowed to pass along the fees, great, you can do that. That, if they're paying for the cut and the service, and then you have the credit card fee, it's just the tip portion that is the qualified tip. So that's where, like, I think now is a good time to kind of reset and make sure that what you're capturing as the tip is the actual tip, and you're not throwing in the credit card fees. It's just a good time to reset. A lot of people, you set it up once upon a time 8 years ago, and you haven't really thought about it or looked at it since. Or you set up Tippy 3 years ago and you haven't really thought about it since. Now is the time. Now is a good time because a lot of stuff hinges on this. The individual employees have a vested interest in getting their tips reported properly. The business also obviously has an interest in getting reported properly. So I think it's a good time to kind of reset and just make sure you're doing it the way you want and efficiently too, right? We would like to have this be quick and easy for everyone if possible.
Yeah. And again, because this question's coming up a couple times about, will the employee still get the benefit if will the employer still get the benefit if the employee is doing something different on their personal? I think that was made very clear. As the employer, you need to report all the tips. They need to actually be allocated properly on the W-2. As we mentioned, you probably want to have something in writing that's ensuring that you are getting all of the accurate information from your employees regarding their tip income.
Yeah, and if we have an example where you're capturing all their credit card tips, it's 10,000 a year, and they are telling you they got 0 cash tips. All right, you're okay. On the individual returns, the employee should, in theory, be filling out an additional form to say, I have additional cash tips that I didn't tell my employer about. If they do that, they pay the FICA, they add the income, but then they can sort of deduct it again with the tip deduction. So I think there might be some of that occurs now, because if you're an employee, I know we've talked about this in other settings where it's like, if they're lying about their tip income, they look sort of cash poor on their tax return. It's harder to get financing if you're sort of lying to the IRS about what you made. this might encourage those individual employees to be more honest in reporting their tips, because then they get up to sort of what is the true sort of earning potential here. And that could help them get financing on a car or a house, you know?
Or and also dramatically change the percentage that they're paying. I think what a lot of people don't realize is that underreporting your income in some cases costs you more money long term. So, mortgage interest rates is a good example of what that could look like, to Chris's point. And also, I do realize that when you report in all your income, you still have to pay the Social Security and the Medicare. So that still occurs. But remember, hopefully, you're also going to get that benefit on the back end. I mean, I'd say
You'll
hopefully
collect it someday.
you'll collect it someday. So, there is there is a reason why that exists, to help supplement your income at some point when you're no longer earning income.
And maybe by then, Social Security income will still be tax-free. Who knows? Who
Don't
knows?
make me laugh about that one, but yes,
Uh,
as long as, right, with
yeah,
all of the different stipulations. So
temporary.
I want to just thank Chris very, very much for going through all of these different scenarios, and I certainly want to thank Tracy for helping us do our best to keep up with the chat, because there was a lot coming in. So thank you, Tracy, for that as well. As you see here, you've got Tracy's contact information. So if you need more info, and then of course, if you want to reach out to Chris or I, we can certainly do our best. Chris, if there is some clarifications to some of the things, because we know this is basically hot off the press. I mean,
Yeah.
then you and I, Tracy, will probably
We can get the band back together. Yeah.
we'll get the band back together and try to address anything that either perhaps has changed, or the interpretation has changed, I should say,
Yeah.
by
There will
anything.
definitely be some announcements about how some of these things are going to get reported, and like making sure your payroll providers, like for now, I'm just saying, make sure your payroll provider is going to do it correctly. Well, they're not
Yeah.
going to do it correctly this week, right? It's going to take a while, but yeah, happy to be back. Thanks for having me.
Yeah. And then,
Pleasure.
again, if there's any question that we missed, we apologize. We did do our best, but you know how to get in touch with us. So feel free to reach out. So somebody said, like COVID times. Thanks, Chris.
It is. It is.
I mean, well,
COVID in July.
hopefully not the same, but definitely, as you said, pretty monumental in the terms of some changes. So
We
really,
have 6 months to work this into your tax planning. So
yeah,
it's
yeah,
it's the best opportunity people have had in a long time.
excellent. Excellent. Well, thank you, everybody. I know we had people that had to bounce off, but we can't get the recording available until we stop the webinar. So lots of those questions. We will work on all of that throughout the balance of today, and hopefully have things posted for you by tomorrow.
Thanks, everybody.
Thank you.